Welcome to another episode of Mere Finance. Today we're going to talk about the monetary system. Is quantitative easing and money printed inflationary? We are going to argue that yes, but there is a lot of information out there that says no, all of this printing of money is not inflationary. It's not helping to contribute to inflation. So we're going to argue that. So the context. So there is two types of money. The financial money, which is the printed by the central banks, for example, via quantitative easing. So the central banks are the ones in charge since 1913, at least in the United States, of issuing money, issuing legal tender. So then people can go and spend it. But they don't give it directly to the consumer. They go through different routes. So we're going to explain where. And there's the real economy money, which is how governments, through deficits, and how banks, via lending, bring that money into the actual economy, into the system. So you and I, the consumers, can spend and do business. So financial money, it takes away bonds, right, and swaps them for reserves. The U.S. government issues bond via the treasuries, or issues also, companies issue corporate debt. And this bond, in the times of bonds, the central bank buys them and then provides reserves into the bank. And so bank reserves are financial money. They don't increase anything like monetarily, like physically. They just change in the financial system assets for reserves. As you can see, the total assets of the Federal Reserve have decreased this year from 8.75 trillion to almost 7.5 trillion, which is a good sign because we need to bring down the amount of money that the Fed Reserve has. So why is it that the Fed Reserve is reducing its balance sheet when they're trying to fight inflation? So that doesn't make sense. If quantitative easing is not linked to inflation, then why is the central bank, through this graph, trying to bring down the total assets? And you can see here, from week to week, negative 33 billion, almost 34 billion. And these are the assets that the Fed Reserve has. So they bought these bonds and they put reserves into banks. They have almost 4 trillion in US Treasury notes. These numbers are important because we are going to explain why they have a relationship with inflation. So real economy money. So banks usually lend money based on three factors: the creditworthiness of the borrower, so if you pay your bills on time; the loan yield, so how much banks are going to charge interest and how much yield are you going to make; and the required capital for the loan. So is it going to be an amount that can be extremely stressful for the bank to lend money, or if the person is able to pay it back? If a person makes $100K, they are not going to lend them $10 million. So what's the argument against financial money not being inflationary? That when making new loans, bank literally credit your account out of nowhere, and hence create new deposits out of nowhere. And that government deficits also inject new spendable money for the private sector. So they say it's actually not the quantitative easing that does it, but it's actually banks and government deficits, the ones that try to create inflation. But we think that financial money is inflationary. So monetary expansion is inflationary. And why? Because it has a direct correlation with asset prices. So asset prices inflate or halt when they should deflate. So for example, if you have a really bad economy cycle, what happens? The Fed intervenes, provides quantitative easing, and then with all the money in the system, valuations and credit spreads are affected positively. So natural economy cycles don't run their course. We should let recessions happen. It's part of the capitalism, right? But because we intervene, then asset prices and valuations and credit spreads are affected positively. So QE is a disruption of the natural order of things, and it has been for years. You can see this every time there is distress in the system. In the blue line, then the Fed prints more money. It is insane. This is the Fed's QE versus the S&P 500. The S&P 500 returns, I think based on some studies, 80% is contributed to quantitative easing because of valuations and spreads. So financial money pushes asset prices. People sell their assets or borrow against them, which is the wealth effect, right? The more assets you have, the more collateral you have, so you can use those money into the economy. So defaults and bankruptcies are combated with QE to keep banks solvent, right? Else, when there is a default or bankruptcy, the bank could be underwater. But because of QE, then banks remain solvent. And government deficits, no one wants to buy debt. When you have debt of 150% of your GDP, well, I don't want to buy it because I think you are not going to pay it. So the Fed is the last buyer, as we saw. So it creates financial money to subsidize the deficit. So this is why we think, a lot of people say, no, it's just the financial money. You can do and print and print and print, and nothing will happen. Well, it will keep asset prices elevated, and it will not make normal economic cycles run the course, which actually prevents the punishment of bad economic policy, bad financial decisions by companies and by employees. We always have to punish people that don't produce and don't make good products. It's the course of capitalism. No one invented this, so we need to let that happen instead of bringing all the quantitative easing and keeping people afloat, or businesses afloat, or economic enterprises afloat. So let us know what you think, and don't forget to subscribe to another episode of Mere Finance. Thank you.